the panel that provides access to the Q&A section. If you already have questions, you can go and add those now. We'll also encourage you to submit questions at any time during the presentation. And now I'd like to hand it over to Warren Thomas, Managing Partner here at ExchangeRight.
Okay, thank you very much. Yes, I'm Warren Thomas. I'm one of the founders and managing partners of ExchangeRight. I want to thank Kevin O'Brien for the opportunity to speak with you today. I'm actually calling you from California. We are involved in the evacuation and wildfires that have occurred here. So my wife and I have been living at the Marriott for the last week, and we're hopeful to get back into our home in the next couple days, assuming that they get the water and all the power back on. So, but today our agenda is to look at tax-deferred exchanges and diversified real estate portfolios, and tell you a little bit about what ExchangeRight does. For those of you that have worked with us before and are investors in our programs, we want to again thank you for being an investor in our programs. We appreciate you, and we also appreciate that we are stewarding your assets for your benefit. And so again, thank you for that opportunity to work with you. This is a presentation that will include reference to both our DST, which is 1031 program, and our REIT program. REIT is a real estate investment trust program. We are managing assets under both 1031 and under REIT programs, and so we'll talk about both today, and we're going to get into more of a dive into the whole 1031 process, what a DST is, what a 721 exchange is. So I'm going to get a little bit technical on some of these. So we're going to introduce ExchangeRight, look at net lease real estate programs that we offer, hopefully give you a good understanding again of 1031 exchanges and DSTs, and then this thing that's actually called a 721 exchange as well. Okay, and then at the very end, we will have some time for questions if you have any questions. And I would like to be working within about a 45-minute time frame on this presentation, although I'm happy to go longer if that's needed. So a little bit on me. I am one of the three founders of ExchangeRight. By background, I originally started as a CPA in audit with Ernst & Ernst, which is now Ernst & Young. And then I'm the oldest one in the whole company at 68 years old. And we have about 165 employees, and going from being a CPA, I then ran a CPA practice for 25 years and went into first retirement, and then we launched this company, ExchangeRight. My two partners, Joshua, I hired him in 2006, right out of school, and David Fisher is one of my partners. He was in investment banking. He's also a CPA, and he was one of my clients back in prior to founding the company in 2012. We have grown from starting, with 3 people and an idea. We are now managing $6.3 billion of assets on behalf of investors in our 1031 and our REIT programs. We have over 1,300 properties scattered across the map that you see. The only state that I don't have properties in currently is Vermont. So we are known for being a net lease property manager and program developer. We have 84 tenants. So as you look at the screen, those 84 tenants are primarily investment grade, and they have to be recession resilient. And so when we went into even the COVID era, we found that over 94% of our tenants and our properties were deemed to be essential under that COVID definition. And really, we're looking for properties that will do well in a recession, will do well because there's demand that'll be generated for those properties regardless of the economic conditions. We are in primarily 18 industries, which is necessity-based retail and healthcare. We currently have about 8,900 investors. I'm at the lower left-hand corner there, in both our 1031 and our REIT programs. And we have sent out so far since we started about $2.2 billion of distributions from our various programs. So that's inception to date since 2012. So we send out distributions every month to all of our investors. Our average annual return on our program has been 8.6% on a total return basis, and 100% of our offerings have met or exceeded our original cash flow projections. And 100% of our offerings, if we'd done 2 offerings, that would be something, but we've done about 130 offerings so far. So all of them have met or exceeded projections. And really that, again, is because of what we underwrite, the type of tenant that we type of property we buy will be tenanted typically by an investment grade necessity or healthcare tenant. That's a little bit about the company. On our investors, the type of investors that we're working with, we tend to work. We are typically a more conservative strategy than some of the other 1031 sponsors in the marketplace. So we tend to attract investors that have these particular needs. One, they tend to be moving from active investment management to more passive. If it's a rental property that they own, they may have owned the property for 20, 30, 40 years, and now it's time for them to become more passive and not being day-to-day active. So we have a lot of investors that are kind of transitioning. And then also they typically will have significant capital gains. So capital gains can cause taxation at both federal level and state level, sometimes even city levels. And so they have gains and they're trying to defer their gains. They're also shifting from growth to preservation of capital. So, often I've owned rental properties for many, many years. And when you're buying and you're climbing under the house and fixing your own plumbing or doing your own yard work and all of that on your rental property, you're doing it because you're trying to grow your income. Yes, the cash flow is important, but you're trying to grow. Well, now a lot of our investors are shifting to capital preservation. They don't want to lose what they had. It's really, in a sense, really sad here in California because the areas that have been taken out, like in my immediate area, the Pasadena, Altadena area, there are many people that accumulated a lot of wealth in their home or their rental property, but their rental properties were all based in Pasadena or Altadena, and they may have just lost a significant amount of that. So, by diversifying, going into programs like these, our focus shifts to a preservation mode. And then finally, increasing focus on estate planning. These programs are very estate planning friendly. So whether it's the REIT program that we'll talk about or the 1031 program, they both will have multiple options for liquidity, and they'll qualify for step up in tax basis. So you won't have to pay taxes or your heirs wouldn't have to pay taxes when it's finally time to go out of the program. So again, the right-hand side of your screen, our investors typically, they want tax deferral. So whether it's a 1031 tax deferral or it's the depreciation benefit under the REIT program where you can get, say, 60% of your income comes tax deferred, where you don't pay tax on it because of depreciation, that's important to our clients. Again, secure capital, I've already mentioned. Stable income has been a hallmark, and then the strategic exits, having multiple exit options has been important to our 1031 program, and having quarterly liquidity on our REIT has been important to our cash or IRA investors. Okay, so that's a little bit about what our investors are looking for. Our 1031 investors, their average age is actually 72 years old. So it gives you, again, a picture of who we're working with. But for those that are 40 years old, 45 years old, or what have you, if you're on the younger side, this might be appropriate on the 1031s for that more conservative part of your real estate portfolio. So you may want to shift and diversify some into this more conservative approach. Okay, so what do we focus on? We focus on properties that are designed to create broad diversification and long-term streams of cash flow. So we're focusing on historically recession resilient industries, then essential businesses within those industries. Then we narrow it to investment grade credit tenants, and then we narrow that to long-term leases. I'm not buying something where the lease will renew within a year or 2 years, and you run the risk of them not renewing. So I want long-term leases. I want investment grade, looking for essential industries and recession resilient tenants. So okay, I'm going to just give you a picture before I get into the tax details of the law. I'm going to just give you an overview of the programs real quick. So this is a DST program, and it's one, we call it Net Lease Portfolio 63. And in a DST, there are DSTs that will have just one asset in them, one property. And there are DSTs that will have diversification into many properties. At ExchangeRight, we take the position that because of the clientele that we are serving, the investor that we're serving, we're looking for diversification in our programs from day one. So you'll very rarely see us do a 1 or 2 property DST. We're generally going to have a number of properties in them. So this was an example of a portfolio we call Portfolio 63 DST. And as you can see from the picture, it involved FedEx, Tops, which is grocery, Dollar General, which are dollar stores, Tractor Supply Company, BioLife Plasma, as a few of the tenants that are in this program. And this program, we were raising equity, and this one of $75 million. And then we also had a debt component in this, which I'll show you in just a moment. So this would be a program appropriate for those doing 1031 exchanges that may have needed to replace debt that they had on the property they sold. We will do similar program to this with no debt. So I always want to have a program available to you that has some debt built into it and some all cash programs on the 1031 side. Looking inside the box on this particular program, again, start in the upper left-hand corner, you'll see that the equity that we raised on this was $75 million. We had a $50 million mortgage that we put on the portfolio. So we have $125 million worth of property in this portfolio. The cash flow started at a 5% on the equity of an investor would put in. This one had a 40.29%, I'm in the top row to the right, 40.29% debt ratio. And again, that would be used by somebody that maybe they sold a rental property that had a mortgage on it, and they need to take on a mortgage in order to satisfy the IRS requirements. So you're typically going to see in our programs a 40 to maybe 46% debt ratio these days, because debt is not cheap, right? Debt is fairly expensive. So I want to limit my debt exposure because I don't want to overburden any of my portfolio, my DSTs with debt. On the second line down, if you go to the far left, you'll see my average weighted lease term on this portfolio was 12.4 years. The minimum purchase was $100,000. So an investor that needed to replace $100,000 might come into this. Investor that needed to replace $12 million might have come into this with their $12 million. So it doesn't matter to us on the size of the investment. And actually, if you're working with a transaction that only needs 60 or 80,000, then talk with the firm, and they'll ask me, and I'll probably say no problem. You can put a smaller amount into. Sticking with the second line down there, you see this one had 15 total properties in 15 markets, 9 tenants, 6 industries, and it was diversified across a number of states. Now the chart there. The pie chart will show you the percentage of revenue that is coming from each tenant. And again, My emphasis is going to be on diversified income streams. So FedEx was the lead tenant here with about 92% of the gross revenue coming from the FedEx building. And then the market, the grocery was 21%. Schnucks Grocery was another 10%. BioLife Plasma was almost 10%. Daybreak Market and Fuel was again about 9%. Then we get into Dollar General with about 9%, Tractor Supply with about 5%, Dollar Tree, and then Dollar General Plus. So again, just an overview of what a DST might look like. I buy about 100 million of property every 75 days. So I'm always building the next DST. So if you're working with a 1031 exchange transaction and it's 3 months out or it's 6 months out, we will typically have both a levered offering similar to this and a unlevered or all cash offering that will have anywhere from 3 properties to 8 or 10 properties in it. Okay, so I'm always building them. You don't come into a program until I've already bought the building, so you know exactly what you're getting in, what you're putting your money into. And if you do come into one of our programs, if you were coming in today, your first check, the distribution will be February 15th. So there is no waiting, no delay on that. As soon as the funds are invested, they go right to work. Okay. From a tax perspective, it qualifies for 1031 exchange, and we look at holding these properties in the DST for actually a fairly limited number of time. Usually, you're gonna only be in our programs for about a 4 to 5 year program time period, and then we give you exit options because the older we get, the more we like to have options, right? Even if we're younger, the more we like options. So this particular DST, as with all of our DSTs, we intend to offer at least 3 exit options to our investors. One exit option, the first one you see on your screen, is what we call 721 exchange. That's where you could actually take your money that you had put into this DST, and when we go full cycle, you could roll that money into our REIT on a tax-free or tax-deferred roll-up. And so instead of being part of this $125 million portfolio, now you're going into a REIT that has multiple, where you're $1.5 billion, $2.5 billion of properties. So theoretically, by taking a 721 exchange option, you're theoretically mitigating your risk, right? Because you go from having 15 or 16 property exposure to now having multiple hundred properties, and so you're diversifying your lease rollover risk, your credit risk, your location risk. All of those things are you having more diversification. And currently, the cash flow is even a little bit higher in the REIT than it is in the DSTs. So where that cash flow may have started at about a 5, the REIT is currently paying about a 6. So we get people want to go to the REIT as quickly as they can because there's a cash flow advantage to it. But the DST won't give you that option until we reach the full cycle of the DST, which has been on average about 4.5 years. Okay, that's exit 1. That's one option, and it is an optional choice that you will make, and you can move some of your money in one way and some of your money another way. So second option would be you could do another 1031 exchange, go into another DST, or you find a rental condo you want to buy. You can take your cash, roll it out of the DST, and put it into another rental property. Now, you can only do these exits when the whole DST exits, so you can't, call it next month and say, "Oh, I want to liquidate." IRS does not allow DSTs to keep cash on hand to be able to liquidate people at will. It's one of the rules that IRS has set up. So the properties actually have to go full cycle before we can give you these options. But so first option, you go to the REIT. Second option, you can do another 1031. Third option, you can simply cash out. We don't have too many people that cash out. Those that do cash out would typically be those where perhaps one of the spouses has passed away and they've gotten a step up in tax basis, and so they can exit and they don't have to pay any tax on those capital gains. Okay, so that's a little overview on the 1031 program. On the REIT program, also it's a net lease REIT. So what you see with this, investors that are working on working with Kevin on our income REIT, they are going into it with either IRA money or cash money that they're repositioning, and their motivation may be very much the same. They're looking for cash flow and they're looking for a tax advantage. From a cash flow standpoint, we have a couple different share classes that you could come into. So I'll just mention this one is our what we call our ER share class, and it's paying a current distribution of 6%. On the top line there. 6% cash flow. So if you need cash flow in your IRA, or you need cash flow monthly, or you just want to have that cushion, you can come into this portfolio, and you've got a base cash flow of 6. And then because of the tax benefits associated with that cash flow, because of depreciation, depending on your tax bracket, you may be getting equivalent yield of about a 9 to 10. If you were comparing this with a CD or a money market account, because of the tax breaks associated with it, you probably would have had to earn equivalent to about a 9 or 10% to have that equivalency. So the next thing up in the upper right, you see this thing called AFFO to distribution coverage ratio, 105% basically. We won't pay distributions out of borrowings. We don't pay distributions out of capital that we're raising. We have to have capital earned by the REIT that is paid out. So historically, our overage has been 5% roughly. So we're paying out that 6, and we only pay out of earnings. On the second line there, you'll see that it says 1.2 plus B. So our current valuation, we have our REIT valued every quarter by KPMG, which is a large accounting firm. And our current valuation of assets in the REIT is 1.2 billion, and we are growing the asset base with new acquisitions constantly. So of all of the assets in the REIT up through the end of December, we've been at 100% rent collection on all of our assets. I don't expect that'll continue forever, but it's been very good. Our trailing 12-month cash interest coverage ratio, which means how much income is covering the debt or the mortgages on the property, well, we've got about 2.5 times the amount of income that we need, that 2.52x that we need to cover that. And we had, as of September, we had 353 properties in the REIT. We acquired additional since then, so I think we're at about 370 properties in the REIT today. And they cover 34 states and 37 tenants. So that's a little picture on the REIT. This share class of the ER share class, it's built for income, growth, and tax efficiency. And you can talk again to Kevin about the total return, but we think it's a very handsome total return for you, whether you're, again, looking for it in your IRA or looking for it for just a cash investment. The ER share class is a share class that is illiquid. This one is an illiquid share class for the first 5 years. And so this may not be appropriate for what you're doing unless maybe it's an IRA or cash you really don't need to access. We have an A share class that has quarterly redemptions, and so which means you can get access to quarterly liquidity, and it may be more appropriate given your particular situation. The economics are a little bit different, but either way, either share class may be something that you should look at. Okay. So now Kevin had asked me to spend some time on the technicalities of 1031 exchanges and DSTs and this thing that we call the 721 exchange. And so just a little bit more, my background, I started again as a CPA. I ran a CPA practice for 25 years, and my master's is in tax. And so tax deferral, capital gains, recapture taxes, all of these things are areas that I've lived with for many years on behalf of clients and myself. But the reason why people will do a 1031 exchange, these are the primary benefits. Is one, you can defer your capital gains taxes indefinitely, until Congress changes the rules. And 1031 exchanges have been around since the 1920s, and so it's over 100 years of history. They certainly have played with the concept of changing the rules, and we did a lot of lobbying about 5 years ago, 7 years ago. But a lot of Congress, a lot of the Senate, they own rental property and they have lots of constituents that do. So we believe 1031 exchanges are going to be around a long time. We will be actively lobbying on that, but 1031 exchanges allow you to defer your capital gains taxes. You exchange your property to something else that qualifies into another property or DST, and you defer the taxes. You also can defer the depreciation recapture. So many of us have taken depreciation for 20, 30, 40 years on our rental properties, and we've depreciated those things down to almost nothing, right? Well, if we had to recapture that tax through a sale, we're going to be paying capital gains, and there'd be some premium for a recapture tax perhaps as well. And so we get out of that by doing a 1031 exchange, right? So you want to do 1031s to avoid that taxes. Many people also, the third bullet point here is that they can create additional cash flow over and above what their rental property is currently spinning off. Because you look at your rental property, insurance has gone up, utilities has gone up, gardening's gone up, taxes, all of this stuff is moving up with inflation. And sometimes you're unable to keep your rent up, and maybe it's because you want to keep that great tenant that's been in there for 20 years, but you may be sacrificing a lot of rent, whereas your costs are not decreasing. So in evaluating whether you want to sell a piece of property, you want to look at what you're really getting in cash flow from that property on a real level after reinvestment into the walkway or the plumbing or the roofing, whatever. You need to look at everything, and maybe you can create additional cash flow by being in a 1031 with a DST. Usually we find that is the case, not always, but usually. And then you can create additional depreciation benefits, whereas I mentioned that a lot of our investors have used up all their tax bases. They've taken depreciation for 20, 30, 40 years. You might have a property that's 100% paid off, has no mortgage, and we find that some investors want to come into our DSTs that have a mortgage. Let's say they have a $2 million property, no mortgage on it, so they get $2 million. They want to come into a DST that has mortgage. Why would they want that? It doesn't make any sense, right? Well, it does make sense from the standpoint of you could use your $2 million, buy into a DST that has a mortgage of $1 million to $1.5 million, and now you get to redepreciate that next $1.5 million. And so you get new depreciation, fresh depreciation. And you'll have to look at the DST programs that have debt and decide, well, do you want that or not? Because you don't have to use it, but we do find a lot of investors are saying, oh, if I do that, I can now shelter, I'm going to get this income, my income's going to go up, and I can shelter 35% of it. Maybe that would be you, I don't know. But that's another motivation for doing a 1031 exchange. So what is a 1031 exchange? You all kind of know it, but no gain or loss will be recognized on the exchange of real property that was held for the productive use in trade or business or for investment purposes. If you go into another property held for, again, trade or business or investment purposes. So this is going to mean your rental property can qualify to go into another rental property, and doesn't matter, like-kind exchange, doesn't matter whether you're going from a residential to commercial, where you can go from owning a 4-unit apartment or a single-family residential to owning Kroger's and CVS or what have you. You can do that. It all qualifies as like-kind. I'm going to give you another slide to to show you how much is like kind to like kind. The top graphic here that you see on this page, you see that you might have purchased, if we look at the top left, your purchase price might have been, $400,000. And now the value of this duplex has gone up to $2 million or to $1 million, right? So you've got a big capital gain. And if you just sell it outright, you're going to pay federal taxes, depreciation recapture, state taxes, and it's going to take a chunk of that value away. And that's what that illustrates on the top right-hand side. You pay the taxes, takes the value away. Or you go down to the next illustration, you see you sell the same duplex, but now you do a 1031. And whether you do a 1031 into a rental condo or you do it into one of our DSTs, you get all your money working for you. There's no haircut. Government doesn't get any of it, right? And if you found that you needed to take some money out, you needed $100,000 or whatever, then you take out what you need, you pay some taxes on that, but everything you reinvest into another rental property is tax deferred. Now, this will not work for your residence, and it will not work for your vacation home unless your vacation home is really an Airbnb type of situation, but it does work for your rental property, and you don't have to go from a duplex to a duplex or a residential rental to a residential rental. You can go into a lot of different asset choices. So this is going to illustrate what I've just said. You take your rental property and you buy another rental property. That's one choice, upper right. Or you take your rental property, you go into a DST concept. That will work. But the last illustration, you go from your home to a DST, you're not going to defer anything. So under the IRS rules on Section 121 on home ownership, you only get to defer the original value of your home, what you paid for it, plus another $500,000 if you're married filing joint, right? And everything else would be taxable. So some people will actually convert their home into a rental property and then do a 1031 exchange. That may or may not be a wise move for you, but some people do that. Going over to the left-hand side of the screen, you'll see examples of qualified property. And these are a little bit surprising, right? You're saying you can exchange from any of these to any of these, right? You can go from raw land to anything here, oil and gas, or tick interests, or water and air and mineral rights, or doctor's offices, or retail property. They all qualify for 1031 exchange. So if you're in a rental condo apartments and you're owning those today, or single family rental house, you can pretty much exchange for anything on this list, including the DSTs that we have or that others have. Okay, so that's all like kind property. The rules on how long you have to go and what the process is. So rule number 1, seller must purchase like kind. So we've just gone through that. Rule number 2, on the far left of your screen, seller may not take constructive receipt of the sales proceeds of their property. So you can't have escrows give you the check and then reinvest it. You actually have to use what we call a qualified intermediary, and they act almost like a second escrow company. But the day you close on the sale of your rental property, your money is wired over to the QI, the qualified intermediary, also called an accommodator or a facilitator, and they're holding the money while you're then telling them, oh, what do you want to replace your old property with? What is your new property going to look like, right? What's the address, etc. And then when it's time to buy, they will wire the money out of that qualified intermediary account, the accommodator account. They'll wire it over to your new escrow, and then you close on what you're going to buy. And you have to have them as a middleman, because if you get constructive receipt or that the money from your sale, if it hits your pocket, it hits your bank account, you can't do a 1031. So you have to have a QI in the middle. We are not a QI. We used to be the membership chairman for the National Federation of QIs. So we can refer you to anyone, or Kevin can, But there are very good QIs. You want to just make sure they're bonded, insured, and holding your money in a separate account so they're not commingling with anybody else. Okay, third bullet point to your left, from the time that the qualified intermediary receives your money, the replacement property must be identified within 45 days from the close of escrow. So you have to actually tell the qualified intermediary what it is that you want to replace your old rental property with, and you have 45 days to give them an ID sheet, which says, okay, this is what we want to go into. After that 45 days, you have to go into whatever you identified, or else if you go into anything else, it's not going to qualify for 1031 exchange. So you've got a 45-day identification period, and you might identify our DST, you might identify another rental property, but whatever you identify, that's all you've got. Now, if you're in a disaster, a federally declared disaster area, which already Southern California is qualifying, then they may extend the deadline by quite a number of months. Like in our case, we just heard for this area of Southern California, it's extended to October. So you may find that you were on a list from the East Coast where you had property where the hurricanes came up, and maybe you got an extension there. But generally, 45 days to ID. And then the last bullet point to the left is that you must replace the property within 180 days, meaning you closed your escrow on your sale, you've got 180 days to replace the property. The diagram that sits on the middle and the right-hand side here, if you start with step one, first thing you're going to do is you're going to list the property that you want to sell. And then while you're going under contract, identify who your QI is going to be. And again, there's lots of choices to make. Brian can help you with that, or Kevin can help you with that. We can help you with that. Then you sell your property. The sale of the property, if you look at the arrow going up, you see that the sales proceeds have to go to the QI, and then they hold them until it's time to buy whatever you want to buy. Down below step 3, you'll see that the stopwatch is starting. You've got 45 days to identify, and then you've got 180 days to actually acquire what you want to buy. Okay, so that's the 1031 exchange process in brief. And only when we have extensions and such do we modify any of these timelines. Now, there are rules under which you can identify property. When you're working with a multiple property DST, you're probably going to use what we call the 200% rule, maybe the 95% rule. If you're just looking at buying specific property addresses, let's say you're selling your rental property and you've got 1, 2, 3 choices of this condo, that single family house, that duplex, then you use what we call the 3 property rule. You tell your qualified intermediary by that 45th day what 3 properties you want to ID, and then you put them on their sheet, and then you go buy 1, 2, or all 3 of those properties. So if you're working in a DST like ours are not 3 properties. They're typically going to be more, and so you end up using this rule that we call the 200% rule or the 95% rule. And again, Kevin can talk to you about that, or we can get into it with you. Okay, that's probably enough on that. A DST, for some of you, you are already in our DSTs. And again, thank you for that. Or Kevin may have you in another company's DST product, which is great. Well, what is a DST? So a DST is a Delaware statutory trust, and it is a fractional ownership structure for real estate. Now, there's another term out there called DST, which is a deferred sales trust. That's not at all what we're talking about. IRS is attacking those. They're not attacking Delaware statutory trust, but they're going after these other things called deferred sales trusts. So you got to be careful with those and make sure that your advisor really understands the tax implications, because they can be done right, but a lot of times they're marketed wrong. But in any case, the DSTs we're working with is a Delaware statutory trust, and they are they're considered a grantor trust, kind of like a living trust you might have with you and your spouse. But they are, second bullet point, DSTs are eligible for 1031 exchanges. And there was a revenue ruling that was issued back in 2004, and it's called Revenue Ruling 2004-86, and it sets forth the rules of how DSTs how they work. And as long as you're following the rules, then they're a great method of holding real estate. So with all of our programs, our DSTs, we always have a tax opinion as part of our prospectus. So you can read the tax opinions and understand how it fits into the IRS framework. But you want to make sure that if you're in a DST, you really want to go into those that have tax opinions attached and that they're clean. So that's what a DST is. There are a variety of DST sponsors. ExchangeRight, my company, is considered a DST sponsor. There are a number of them. We specialize in the net lease space. Kevin might have you looking at others that specialize in other types of assets. Sometimes it'll be, maybe student housing is your thing, or retirement facilities or something like that. So that's not our thing. Might be your thing, but we are known for being DST sponsor in the net lease space. Okay, so that's what a DST is, and DST's benefits. It's passive. It's a passive reinvestment option for you. You don't have to get involved in managing the properties. I've got 165 employees. We're managing the properties day to day, and we're sending out monthly checks, right? So you're getting the benefits without having to step into the work. And again, for our demographic, sometimes we're caring for spouses, we're caring for ourselves, or we want to be around grandkids, or we want to travel. Lots of different reasons for maybe wanting to become more passive. Also, second bullet point, your potential for increased income, already kind of hit that. You will need to evaluate your situation and see whether our cash flows will increase yours. Also, it's a way to be diversified. Again, it's sad on like the one client I was talking to back in October that was considering selling some of the rental property up here in Altadena and didn't do it. They didn't diversify. It might be appropriate that you do a little bit of diversification with your portfolio, or maybe you want broad diversification. Each of our programs will be diversified inherently, and it also allows you, from a diversification standpoint, if you own 10 or 20 or 2 rental properties, you won't, by diversifying into one of these programs, you're really going into a different asset class that qualifies for 1031. And so it's a different level of risk and return, right? So you're diversifying that. And then these I mentioned earlier, but these are estate tax friendly. They qualify for the step up in tax basis that you want, so that you can pass this on to, either you pass it to your spouse and get all new depreciation starting all over again after death, because you get a step up in tax basis, meaning you can start redepreciating, or you're passing it on to the kids or to the charity, and these DSTs can be divided into pieces. So if you've got 3 kids, they can each get a third, and just flow it through your living trust, or individual ownership goes right to the kids at your death. Or if you're allocating 10% to charity, we can send 10% of your ownership to charity. It's really, really quite easy. And they get step up in tax basis on death. So that's a benefit. 721, I've now mentioned that a couple times. So what is 721? Well, it's similar to 1031, but a little bit different. So the rule here says no gain or loss will be recognized either to the partnership or to any of its partners upon a contribution of property to the partnership in exchange for partnership interest. Technically, that's what Code Section 721 is. What does that mean practically? It means you can own a piece of a DST, and you can contribute it when it goes full cycle. You can contribute it into the acquiring REIT, real estate investment trust, and now instead of owning those 16 assets or 6 assets, whatever that's in the DST, now you're part of hundreds of assets that are in the REIT. And so there's benefit to that of diversification. And you become a partner with the REIT. So you participate in the economics of the entire REIT. And sometimes that can mean increase on the income. Sometimes it could mean more exit optionality. A lot of different things that could be a benefit to you. And theoretically, the more property, you theoretically are de-risking, because you're de-risking the credit risk, the lease rollover risk, the location risk, all of those things. You're by having more properties, as long as you're going into a quality REIT and not being forced into some junk, a REIT that's junk. So anyway, you have to be careful about what you're buying up front, because and you want to know what you'd be going into if you were to use that strategy on the back end. So this is the combination. If you're trying to go from owning your rental property to getting into the REIT, this is how it works. We're back to your little duplex there at the top. Step one, you perform a 1031 exchange from an investment property into the DST. And then you're getting your distributions from the DST. And then when the DST goes full cycle, step three, you perform a 721 exchange, where your equity goes from the DST over into the REIT, and now you're owning a piece of the REIT. Okay. In our programs, you could choose to do part or all of your money going into the REIT at the end, or none of your money going into the REIT at the end. You can always just cash out, or you can do another 1031 into another DST. So we give you all that exit optionality. But this is how you combine. How do I get to the REIT? This is how you have to do it. It's basically IRS has you sell your property first. You have to do a 1031, and you do it into a program that is targeting initially to be or eventually to be acquired by the REIT. Okay, so that is that. Potential benefits of the REIT is you've increased your diversification. Your return continues to be passive. The REIT has more opportunities for potential growth, and it has that because the REIT can buy property, sell property, refinance, add more capital. That gives us in the REIT the opportunity to create more value. Whereas a DST, we basically buy a fixed number of properties and we hold them for a fixed amount of time. We can't add more capital. We don't sell, we don't refi. It's just more limited in a DST. You get to the REIT, you've got more potential for growth. Okay. And then also on the right-hand side, on the top, you see enhanced liquidity. The REIT offers quarterly liquidity, whereas a DST does not have liquidity available until it goes full cycle. The tax benefits inside the REIT, you'll continue to get depreciation benefits, whether you buy the REIT with cash or IRA, or you buy the REIT through doing this 1031 program and then the 721. Either way, you're going to get tax benefits going to you. And then I already mentioned, but risks and considerations, you want to look at what you're going into up front, so you understand the REIT that is the potential buyer of the DST, and because you may or may not choose to go into the DST or into the REIT, but you want to know up front who is the potential buyer of your DST. So you want to look at that closely. Okay, and then just I'm going to wrap it here pretty quickly, but overall, ExchangeRight as a company, we have about 6.3 to 6.4 billion of net lease assets. Our NOI, which is net operating income, from into our portfolio of DSTs and the REIT, 95%, over 95% of our net operating income is coming from essential businesses. When you look at all the assets across even our oldest programs, our average weighted lease term is just under 8 years on our leases, and then they have multiple 5-year options on top of that. Our debt coverage ratio, meaning how much income we have to cover the mortgages on our various programs, it averages 2.67 to 1. So we've been very conservative with our usage of leverage. If you don't need leverage in a 1031 program, or you don't want leverage, and we have all cash programs for that. The second line to the left, you'll see 99.76. Currently, 99.76% of our 6.3 billion of property is leased, and we are re-tenanting less than 0.25%. So it's very, very little that we're currently re-tenanting. We're in 811 markets with 84 tenants in 18 industries, and we have properties across 47 states. Then you can see the mix there of our tenants. So that's and our lease rollovers and our debt maturities in our programs are very modest. We have very few lease rollovers coming up, and even in our big years, it's only 14% of the portfolio. So it's very, very modest. And then our debt maturities are also very modest. So our tenants are big names that you've seen before, and they do very well in recessions. So I'm going to back up, and I'm going to jump to a couple questions that I see and go from there. So Kevin is asking, does the 721 owner have a similar state reporting requirement as the DST, and significantly larger number of properties with multiple state locations could cause extensive tax reporting? That's a question. Could it? The answer there is a 721 owner, if you choose to go into the REIT's operating partnership, then the REIT will own properties in a lot of states. And you could find yourself getting tax reporting spread across a variety of states. Now, fortunately, most states have what we call a composite tax filing. So we offer to file those state tax returns on behalf of the investors. And so what happens is the REIT files what we call composite returns, and we ask every investor, we say, do you want to be included in our return, so you don't have to file an individual tax return at all? It's the REIT files for the state of Iowa, the REIT files for the state of Louisiana, it files for the state of Maryland, and so that the investor doesn't have to do any kind of filing. And if Maryland had a 3% tax on the net income, and your share of that 3% was, $19, then we will take that $19. But you didn't have to file a tax return there personally. We did it as a composite. So a 721 owner does have the potential for additional state filings, but it's pretty much mitigated with the composite tax return filings. Okay. I hope that answers it. But that triggers another question though that I want to address, and I'm going to go back in the slides, because the state tax reporting, I really want to have investors that are coming in understanding what they're getting into. So this offering that I illustrated real early on, this was a DST number 63 that we did early last year. I'm actually on number 69 now. I just brought out an offering today. So I don't illustrate the current offering because Kevin and his team need to show you the current stuff. But on this particular slide, you'll see that there were 13 states involved in this DST. And out of that, you're going to have some tax-free states, but depending upon how big your equity contribution is into the DST, you could find that you'd have to file in some of those states. And so, if you live in California or you live in whatever state and all your rental properties have only been in California or your state of residence, when you go into a DST, you have to watch this, because you may say, well, I don't want to go into this portfolio because based on the dollar amount I'm putting in, I might have to file 4 new states, or I might have to file 6 new states. So you do need to look at this. You need to talk to Kevin and his team about that. And we can actually help you with that because we know the basic rules. But you'll want to go back to your CPA. In some states, it's a materiality issue where it has to be owing over, $100 or $1,000 to the state. In other states, it's a materiality issue of you have to have over $100, $1,000 of net income or gross income. So, but we can go through that. So be careful of that. When I go to my all cash offerings, you're going to find I'm usually limiting them, as I said, to like maybe 6 properties, maybe 8 properties, and then I'm going to limit them to maybe 1 or 2 taxable states maximum, and then I may have tax-free states again like Nevada, Texas, Florida, but I'm gonna try to limit that state filing exposure. Okay, with that, I don't see any more questions, so and I've used up my 45 minutes plus another 10. So I want to say thank you, Kevin. Thank you for opportunity to be on here with you today. And thank you all, those of you that have worked with us in the past. We appreciate that. If you'd like to see our current offerings, please talk to Kevin and his team. And again, both the REIT's available for cash and retirement fund investing, and the DSTs, we have both all cash versions and the mortgage version available, and happy to work with you and Kevin's team to make those available to you. So thank you. Have a good day. Appreciate the time.